The cash flow statement has three sections: operating, investing, and financing, but the indirect versus direct method only applies to the operating section, the part that explains how much cash the business truly generated from day-to-day operations. The indirect method starts with accrual net income and converts it back into real cash by adjusting for non-cash expenses and changes in working capital. It's faster to prepare, ties directly to net income, and it's the method nearly every analyst, lender, and accountant expects to see, used by 95% of companies. For the indirect method, remember AI equals operating system. A stands for accrual to cash, I stands for indirect, and operating system reminds you of the rule: opposites for assets, same for liabilities. If assets go up, subtract. If assets go down, add. If liabilities go up, add. If liabilities go down, subtract. And that's how the opposites for assets and same for liabilities rule works for the indirect method. The direct method, on the other hand, lists the actual cash inflows and outflows, cash collected from customers, cash paid to suppliers, wages, interest, and taxes. It's a cleaner view of cash, but it requires extra work because GAAP forces you to also include an indirect reconciliation, which is why almost nobody uses it. The direct method never adjusts assets or liabilities. Instead, it uses simple cash formulas like cash collected equals sales minus the increase in accounts receivable, or cash paid to suppliers equals cost of goods sold plus the increase in inventory minus the increase in accounts payable. If they mention working capital changes, it's automatically indirect. If a question asks for cash received or cash paid, it's direct.